Tom, I think that your missile business is second to no one. But what I do worry about, the margins have been going down. Not to your satisfaction. You just had Wes Kramer come in. You had a little change, although the previous fellow did want to retire. You also have, let's just say, classified information that we don't know that brought your margins down. Always made it hard for me to analyze Raytheon, as you know, because it's great to have new orders, but not good to pull down the margins. Will we have to worry about any of that once it's combined? Because it will not be as big a part of the vast mosaic.
Well, I don't think there's anything to worry about. And so it's a kind of a good news story. And one of the reasons why the margin pressure is all these new programs we've been winning. The business grew 9% year over year in the first quarter. A lot of that was in classified work. That classified work is paying to generate the next generation franchises in that missile business. In that arena, those contracts are cost-plus contracts, which tend to have lower margins. Once we get those products and new franchises into production, then those margins will rise.
Right.
So we are in what's called a modernization phase relative for the Department of Defense. And so the modernization budget has significantly increased over the years. For example, in fiscal year 18, the modernization budget increased 19%. It increased another 2-3% in 19, and the president's budget coming forward is another 3% growth. So it's all in this modernization budget, and the missile company's been capturing a large part of that budget. And what that's doing for us is in the future, that's going to provide the franchises for the next generation.
Okay, Greg, I'm sorry to be so a-linear, but you've got two guys, lots of different stuff. I remember, somewhat famously, actually, you came here and you talked about that notion of what was going to happen ultimately with United Technologies Honeywell, which you had told us because of antitrust issues, it wasn't going to happen. Can you delineate why this is less of an antitrust problem than a deal that you didn't really care for, the Honeywell United Technologies?
Well, look, if you go back 2.5 years to the time when Mr. Cody was pursuing UTX, you guys remember that, right?
Yeah, no, it's kind of played out here.
Look, the overlap in our aerospace market, especially the commercial, was tremendous, whether it's environmental controls, APUs, small engines. We were looking at divestitures of $8 to $10 billion. Right? And as we thought about that, that was just all the value creation from the merger evaporates when you've got 8 to 10 billion of divestitures. In this case, you're talking about maybe 1% of our sales. So let's call it 750 million. Insignificant. In the business of the overlaps, again, we'll find good new owners for those businesses. They'll be competitive, but there's just not the antitrust risk that we had with Honeywell. This is a deal that will happen, as opposed to the one that ain't going to happen.
Business will be 45 international, Tom?
About 45% international, and the defense will be around 50%. I would just step back and say year to year that can change. So I would say it's going to be about, which is a great company. Think about it: 50% international, 50% domestic, 50% defense, 50% commercial. But the bottom line is that the underlying technology supports all of that structure. And that's what we'll be able to drive and continually leverage that technology to create those next generation franchises in the marketplace.